This is going to be a little bit more esoteric and technical than my usual stuff, but this is a topic that I'm actually quite worried about. What do you know about Japanese bonds? Probably not much, or if you actually found this video, maybe a bit. To start, I'll need to briefly go over the economic history of Japan for the last several decades. Japan has been in a period of stagnation for over 35 years. This was caused by rampant speculation and their central bank drastically lowering their rates and setting expanded loan targets for private banks to encourage them to process more loans. Then, an extreme rate hike, which ended up, in essence, blowing up the market. The original push to increase loans was caused by the sudden appreciation of the yen in the mid-80s, which endangered the country's export market, which was heavily relied on. This lightly forced encouragement caused banks to approve more risky loans than they normally would have. This sudden increase in buyers drove up land, housing, and construction prices, which in turn increased the amount people needed to request on the now more risky loans. With land and housing prices ballooning at an unsustainable rate, the Bank of Japan pulled sharply up on their handbrake, hiking rates all the way up to 6% in August of 1990. Banks reacted by halting their excessive loaning practices. They had all of a sudden been forced to become much more risk-averse, and now that only a select few could acquire loans, there was no one to buy houses, land, or start new construction projects. The prices for all of these things collapsed by up to 60% in some parts of the country. And soon after, so did the businesses that were heavily involved in the housing market. It was pretty clear early on that the bubble had burst, and within a year, the bank began lowering their rates. That trend would continue through all of the 90s as the economy worsened, culminating in a 0% rate in 1999. Defaulting on a home loan in Japan is and was highly stigmatized. So while there were significant defaults, where possible, people were more likely to buckle down and reduce spending as opposed to forego paying their loans. Most families heavily restricted consumption to make up for the massive debt they had to take out to acquire their houses, which slowed general economic growth. This would only serve to amplify the economic struggle later on in the decade. The true carnage that initiated this period of stagnation was caused by the real estate developers, construction companies, and highly leveraged businesses. While the people actually taking on the mortgage loans were more likely to pay them off, the corporations that were heavily involved in the housing market couldn't. This left banks holding on to all of the bad debt that those businesses acquired to take advantage of the bubble that was created by the banking system in the first place. As a result of the high rate spike, it became very difficult for businesses to borrow more money in the country. While this meant that businesses with plenty of cash simply found it more difficult to expand, those that relied on the loans to function ground to a halt. Many businesses defaulted on their loans as their markets had dried up overnight due to the majority of the public no longer having discretionary income to spend. Many banks ended up shutting down as they were no longer able to handle the large amounts of defaults that they had been burdened with. This event spawned a new kind of bank, a zombie bank. These were banks that didn't actually function. They used accounting tricks to appear solvent, and they had very little to no money to loan out, and very little to no demand for their loans. They were being kept alive by the government and the central bank as lifeless debt holders. These banks allowed Japan to defer the actual losses, and they perfectly encapsulated the Japanese economy for the last 35 years. Instead of experiencing an immediate and harsh collapse, Japan chose a slow and steady one. For the most part, since the crash, Japan has kept its interest rates around 1%, with the occasional spike to 2%, and even dropping so far as to go to negative at times. This is a result of the Bank of Japan trying to encourage economic activity, but it hasn't really worked. For about 35 years, Japan has been economically treading water. It has had very low inflation rates, and sometimes even deflation. This is bad for the local economy of Japan. It highly incentivizes saving, which translates to slower growth for businesses. So the Bank of Japan has kept rates very, very low for a very, very long time, with the goal of stimulating growth in the economy. But because of the massive debt burden that most people are still dealing with, they are not able, or less likely, to spend money. This in turn prevents businesses from growing, meaning there is less need for new loans, which keeps the banking system from expanding. One of the features of a low interest rate is that it keeps short-term bond rates low. The government would prefer if bonds had a 0% interest rate. This would mean that they could essentially take out a loan for zero interest. The central bank, however, has different concerns than the government, as it is their goal to achieve long-term stability over short-term growth. So they on occasion find it prudent to raise rates. In this situation, the government must raise their bond rates as well, because while they want as low interest rates as possible, they still need a buyer. Financial institutions are big purchasers of government bonds, but if they can earn higher rates by storing their money at the central bank, then they would be much less likely to buy bonds from the government. They are incentivized to buy them, however. Private banks in Japan are required to hold a certain percentage of high-quality liquid assets that are easy to transfer into cash in the event of an emergency, and the Japanese government bonds are considered high-quality liquid assets. So private banks are highly incentivized to maintain a portion of their wealth in Japanese bonds. Japanese pension funds have similar rules. They are required to invest in safe, liquid, and reliable assets, and Japanese bonds are considered the safest, most liquid, and most reliable asset. So while there is no hard set requirement for Japanese banks and pension funds to buy Japanese bonds, they are effectively required to buy them. The Bank of Japan, their central bank, also has a balance sheet with an immense amount of Japanese bonds. They have been practicing quantitative easing since the early 2000s, but they heavily ramped up their purchases in 2010. This is a practice in which the central bank buys assets from private banks in an attempt to stimulate growth and give banks a cash injection. They own around 45% of all Japanese government bonds. So banks are even more incentivized to buy them as they know they can turn them around for cash relatively quickly by selling them to the Bank of Japan. This all means that Japan isn't very concerned with private investment firms or individuals buying their bonds, as they have soft-locked a large portion of their institutions into buying them. As such, most local Japanese investors, looking for better returns with similar safety to Japanese bonds, tend to buy U.S. Treasuries instead. They usually have 2 to 3 times the return of Japanese bonds, and there's a large amount of trust that the American government will settle its debts. Japan is the single largest holder of United States debt, and it is by a significant margin. Treasuries are U.S. bonds that the government issues, so it is essentially a loan for the government. They pay out a set amount to whoever owns them over a set amount of time. What they pay out is fixed, but the value of the bond can vary depending on supply and demand. If there is a lot of demand, the price of the bond increases, but as it only pays out a fixed amount, what you make off of it decreases. So the more demand, the lower the yield. There are many time lengths that treasuries can come in. They can range from paying out in as little as 4 weeks all the way up to 30 years. In general, the shorter the time frame on the treasury, the lower the interest rate. It's not always true, but it is mostly true. Lower time frame bonds are very closely related to the federal funds rate that the Federal Reserve determines. The longer the time frame of the treasury, the less pegged to the FFR the rate it pays out is. The longer bonds are more closely tied to the supply and demand of the private market, and as such, the more demand, the lower the rate the government has to pay. As Japan is a major holder of our treasuries, they are directly responsible for a large part of the demand for them. Their increased demand helps keep our interest low. Japan's low interest rates have caused Japanese investors to seek outside safe investments. So in other words, our enormous government debt is being artificially lowered by the enormous Japanese debt and low interest rates, which forces their investors into our treasuries. There is another benefit to Japanese investors besides higher interest payments when they buy U.S. treasuries. To buy U.S. treasuries, you need U.S. dollars. So there is a large volume of exchange in currency between the yen and the dollar. Their relationship is extremely important, and over the past 30 years, the dollar has been better at retaining its value compared to the yen. Currency strength isn't the same thing as inflation, though they are related. Strength is essentially determined by the rate of exchange between two currencies. So if you have a strong dollar and a weak yen, it means that there is more of a demand for the dollar than demand for the yen, and as such, you will get more yen when changing dollars into yen. Say that you have 100 yen and you are able to convert that into a single dollar. You wait a year, and now you can exchange that dollar for 120 yen. You have made money by storing it in a different currency at a rate that outpaced inflation. So, if you are a Japanese investor who has converted your yen into dollars to buy treasuries, you make money off of the interest paid by the US government, And then, if the dollar to yen strength increases, you get a bonus when converting that money back into yen. Now, this only works if the yen is weak and the dollar is strong, but remember, part of the reason the dollar is strong is the demand for it. As it serves as the global reserve currency, or the currency that countries do business in, it is always in high demand. Part of that demand is that it is used to buy treasuries. So Japanese investors buying US treasuries helps keep the dollar strong and the yen weak. It is a self-fulfilling cycle. Japanese investors aren't the only people that try to make money off of this. There's this thing called the yen carry trade. In essence, this is a strategy used by investment firms, asset managers, and other institutions that takes advantage of the weak yen. Say an investment firm wants to buy some treasuries. They can buy them directly, or they can take out a loan at a Japanese bank in yen. They then swap that currency from yen to dollars and they buy treasuries. In this instance, because Japanese interest rates are near 0%, you get to take out a very low interest loan. You then get to make money off of the treasuries, and then if the yen weakens at all in the time frame of your loan, you make money off of the difference of the conversion rate. There's always a chance that the yen will get stronger, but historically it's been very low. These types of loans are a way for firms to access really cheap cash and make a modest return. The risks are relatively low, though that is only because Japan has been in a period of stagnation for so long. The scarier side of the yen carry trade is the leveraged version. Here, institutions take out a loan in yen, convert that to dollars to buy treasuries just like before. This time, however, they then use those treasuries and cash to take out a repo loan in the United States. A repo loan is when you sell your asset without actually transferring ownership with the promise to buy it back later at a slightly higher fixed price. They then take that repo loan money and buy more treasuries. So, say an investor has $50 million. They take out a loan in Japan for $50 million worth of yen. They then convert that yen back into dollars immediately. Buy $100 million worth of US treasuries. And then take out a repo loan at a bank for $90 million. Finally, they buy another $90 million in US treasuries. They now have turned $50 million into $190 million worth of treasuries. Even though the repo purchase has transferred ownership to the bank, the investor keeps the actual bonds and the interest that they generate. At the end of the cycle, when everything is happening normally, the bank gets paid back the $90 million plus the interest, and then the investor converts the original loan back into yen and repays that loan. If the dollar is stronger than it was when they originally took out the loan, then they get to pocket that difference. They then get to keep the interest that they earned off of $190 million in treasuries while returning most of the principal back to the original lenders. We are dealing with very large sums of money, but what the investor makes is primarily just the difference between what the treasuries pay out and the loan terms. So as long as the treasuries pay out more than the investor has to pay and the yen stays weak to the dollar, they will generate a profit. What happens then if the yen gains strength while the loan is still out? This can cause something called a margin call. It is a situation where the collateral put up to cover a loan becomes smaller than the loan amount. If the person taking out the loan can't add to the collateral to cover the loan, the lender forces the investor to close out of their position to make good on the loan. This would force them to sell their treasuries before they can fully pay out. If the yen becomes too strong, then the conversion on the back end consumes more than the investor has. They will be forced to sell their treasuries immediately. This is a disaster for the investor, but it doesn't have too much effect on the market. That is, until you realize that there are hundreds of institutions doing this all at once. There's no hard number when it comes to how much money is actually tied up in the yen carry trade, but the estimates are around $1 trillion. If the dollar weakens, or the Japanese raise their interest rates, there is a chance it will trigger a mass sell-off of US treasuries, which would increase our debt levels, increase inflation, and weaken the dollar even further. It's a good thing that there is a low chance that any of this will happen. Japanese bond yields are increasing due to inflation concerns for the first time in over 20 years, and Donald Trump wants to weaken the value of the dollar to boost exports. Japan has finally got the inflation that they've been waiting for. For the past 3 years, Japan has experienced significant levels of inflation, and the Bank of Japan has to legitimately consider raising the interest rates. This means their economy is finally on the move again. And while it is no guarantee that they can maintain sustained growth, they at least have signs that things are moving in the right direction. The implication for the United States, however, is grim. While Europe as a whole holds more treasuries than Japan, Japan holds more US treasuries than the value of the entire GDP of Saudi Arabia. If long-term Japanese bond yields rise due to a fear of inflation, this increases the chances the Bank of Japan will raise their interest rates, which would result in short-term Japanese bonds increasing what they pay out, making them more attractive to Japanese investors. They will be more likely to buy Japanese bonds instead of US treasuries. This will slowly decrease the demand and raise the cost of issuing new debt for the United States. Our debt levels would begin to rise. For Japan itself, these are tricky times. Some of the debt from the crash has been paid off, but not a substantial amount. And as there has been little to no inflation in the country, wages have been stagnant. Now that they finally have some inflation, those stagnant wages mean that the Japanese have been able to purchase less for the same amount for the first time in a very long time. Some younger Japanese are seeing price increases for the first time in their entire lives. What happens next will depend heavily on the actions of the government, the Bank of Japan, and the local businesses. The government of Japan plans on running a budget surplus, but the new Prime Minister, Takaichi, is hell-bent on spending to get the country out of their current situation. She has promised to cut taxes and increase spending, and she has called a snap election in an attempt to bolster support for her aggressive budget plan and vision for the country. I fear that she may be walking face first into her very own Liz Truss moment. The original budget plan would have resulted in a 3.6 trillion yen surplus, while Takaichi's plan would result in an 800 billion yen deficit. This plan has spooked investors, and while they are already fearful of the inflation that they have seen over the past couple of years, when her new budget plan was announced, the 10-year Japanese bond yield rose to the highest it's been in 27 years. And remember, high yield means low price. Low price means low demand. Low demand means low confidence and a higher cost for the government to issue new debt. Fear of inflation causes long-term Japanese bonds to increase and puts pressure on the Bank of Japan to increase rates, which they are already considering because of inflation. This will cause short-term bond prices to increase, which makes them more attractive to Japanese investors who had historically been buying US treasuries instead. Now that Japan is buying less and less US treasuries in favor of their own bonds, the US dollar weakens due to less demand and the yen gains strength. This has the potential to cause a margin call on all of the leveraged yen carry traders who are then forced to sell their US treasuries so that they can pay off the difference in the exchange rate, which will then cause our treasury yields to skyrocket, which weakens the dollar even farther. I fear that this is exactly what Trump is hoping for. He has been calling for the Fed to decrease their rates every other week that he has been back in office. He doesn't care about long-term inflation because he wants the economy to look good while he is here. This is why he's been attacking the Fed and the Fed governors so much. He doesn't care about its independence, and like all other aspects of the government, he wants direct control. He has also said many, many times that he wants a weak US dollar. This plays into the ludicrous idea that he has that a trade deficit is a threat to our country. A trade deficit simply means that more things are being imported than exported. If you have a strong economy with wealthy citizens, they are going to be more likely to import goods from a poorer country because they have more money to do so. Deficits on their own are not a cause for concern. He also wants a weak dollar because it increases exports due to them being cheaper for other countries to purchase. Think of it this way. If you are in another country trying to purchase something from the United States, you need to exchange your currency into dollars before you can buy it. If the dollar is strong, you can't buy as much stuff because the conversion rate is bad for you. With a weaker dollar, you get a better exchange and you can buy more stuff, which increases the number of things that are being exported from the country. The downside is, like with lower rates, this can increase inflation. Before Trump took office, the country was extremely afraid of the inflation that was caused during COVID. People assumed that Trump would be better than Kamala for the economy, so they voted for him, even though historically, he has tremendously increased our deficit. The big beautiful bill he's pushed through has added $3 to $4 trillion to our deficit over the next 9 years. That's $3 to $4 trillion more than we would have already spent. 96% of the cost of his tariff policy has been paid by U.S. citizens. Every time he increases the tariffs on a country by, say, 20%, it gets 19.2% more expensive for you. He wants the Fed to cut rates, which increases economic growth, but also increases the chances of inflation. He also wants a weak dollar, which also increases the chances of inflation. He has just recently come out and said that he wants to drive housing prices higher to increase people's net worth, and that he doesn't want them to be lower so that people that haven't worked hard enough can buy a home. He is doing everything that he possibly can to cause an increase in inflation and an increase in prices, which is a slap in the face to every American who voted for him to do the exact opposite. The collapse of the yen carry trade would fit in exactly with his plans. It has a high chance of weakening the dollar and increases the chances that the Fed will decrease their rates. This collapse would also increase the price of oil and metals, as they are dollar-dependent commodities. And as the U.S. is the largest supplier of oil in the world, this would increase the value of our supply. But this is all being done at the cost of the value of the dollar, other countries' faith in us, and higher inflation. The downside to a weak dollar is that imports become more expensive, which again fits with his tariff goals. He is completely against free trade and open markets. He believes that deficits are bad and that import costs rising and export costs decreasing is a good thing. Every economic action that he has taken has been to increase inflation and make the cost of goods rise. We may not be feeling the results fully yet, but it is coming. Everything is going to become more and more expensive, and apparently it's exactly what he's aiming for. When the 10-year Japanese bond spiked, the New York Fed, at the behest of the Treasury Department, performed a rate check. This means that they called up brokers and asked what the exchange rate was between dollars and yen. This is the last step before actually intervening, and it means that the Treasury was planning on weakening the dollar to strengthen the yen to compensate for the bond spike. This led to a sharp and sudden loss in the value of the dollar, and it put many yen carry trade positions at risk. Things have since stabilized after the Treasury Secretary claimed that the U.S. had not actually intervened, though it has certainly sent the signal that if things continue on their path, we may in the future. What this all means is that we are heavily entwined with the Japanese economy. What happens there has a direct impact on the cost of our debt and the trust in our currency. My worry is that everything this administration has done and said seem to indicate that they want Japanese interest rates to rise and the collapse of the yen carry trade. I don't care about the traders themselves. I think the leveraged strategy is extremely reckless. What I worry about is the ripple effects of its collapse. What will that do to inflation? What damage will it cause to our financial institutions? What will it do to the world's trust in the United States? And like all things this administration does, how it will result in the reduction of reliance the world has on us. This will be a seismic event, and no one can truly know the impact it will have. Tomorrow will be the snap election that Takaichi has called for. She's hoping to cash in on her high approval ratings. If she wins, she will use this as proof that she has the mandate of the people. This will include her budget proposal to run the Japanese economy hot while cutting taxes. If this happens, inflation will run even more rampant and the yen will strengthen. Japan will slowly start to divest from U.S. treasuries, and the risk of the carry trade collapse increases drastically. We are at risk of her people winning, but there is no guarantee, and there may be enough fear that the trade winds down slowly on its own. No one can know for sure. I can't see the future, and I'm not saying that any of this will happen. It's just something on the radar, something that I think people should be aware of. I hope I'm wrong, and that it all works out, that Japan can gradually repair their economy, and that we slowly develop a more healthy economic relationship. All I know is that it feels like our administration is happily playing Jenga, hoping that this time, this block will finally topple the tower.